Are you prepared for the coming economic collapse? Because here we go. In 2024, we're going to be seeing regional banks falling and failing hard and fast. We're already seeing it. So this is not some conspiracy theory, tinfoil hat, fear mongering. It's already happening. So if you're going to write fear mongering in the comments, save your typing fingers because it's already happening. There were major turmoil in the banking industry last year, of course. We saw the collapse of Silicon Valley Bank, Signature Bank, First Republic Bank, all went down like a string of dominoes. Later in the year, we saw the demise of Silvergate Bank and Heartland Tri-State Bank. Combined, their $440 billion in assets created the biggest collapse since the inception of the FDIC. Think about it. The FDIC had to step in and use up almost the bulk of its insurance money to cover most of these losses. Unbelievable. So you might want to ask yourself, how much money does the FDIC actually have left? The answer is not very much. When you dive into the details of the FDIC, you will be shocked. You will be stunned, and you will leave with your jaw dropped. I'm telling you, it's a stunning thing once you realize that the emperor has no clothes. While we've yet to see any massive banks fail in 2024, we've seen a number of regional banks failing, one after the other, month after month in 2024. So it's only a matter of time until we see the next big shoe to fall. And these small banks are being gobbled up by the big boys. Here's why this is happening. This is one big piece of it: commercial real estate. All those commercial real estate loans coming due this year into next, and all of these small regional banks are expected to face major turbulence. Office, retail spaces have faced high vacancy rates in the past few years as work from home culture took over. The shift has changed the game in the office space industry, leaving many buildings totally vacant or 70% vacant. This, combined with continued high interest rates, is creating a pinch for lenders and leaseholders. So if you've taken out a commercial real estate loan and you're coming back to try to refinance it because it was a 5-year flexible rate, and now the rates are, of course, way higher, that commercial bank, that small local regional bank, is going to say, sorry, we can't do that. We can't refinance that. We don't have the assets to do that. We don't have the money to do that. Most leaseholders have no interest in refinancing. At this point, many commercial properties are valued lower than the debt. And with that way, the rates have been, of course, they've increased over the past few years. It just doesn't make any sense to refinance into a higher interest rate loan right now. You see? So the commercial real estate runs on debt. But when the debt doesn't fit the deal, someone has to take a loss. And in commercial real estate, especially high-rise office spaces, the losses are enormous right now. Even big-name companies like Blackrock have defaulted on their commercial loans. Despite any effort made by regulators to ensure stability and faith in the banking sector, there's still a lot of risk happening. Listen to what the FDIC chair, Sheila Bair, had to say. This is former FDIC chair, Sheila Bair. I love when these people leave these posts because when they're former, they can speak a little bit more extemporaneously about what's really going on here and about the turmoil that's coming ahead. Listen.
We're kind of in the same place we were last spring and still at the same risk of uninsured deposit runs. So I think that's something regulators need to deal with and go to Congress and get reinstatement of the FDIC's emergency authority. They're trying to cover this through lending facilities at the Fed and the Federal Home Loan Banks, but that only works until it doesn't. That's much more expensive sources of funding. And it's not, if you're an uninsured depositor, I don't know if you're going to wait around and think, okay, they can borrow plenty from the Fed. If you think the bank's in trouble, you're going to be worried. So I do think this is still a problem.
Any bank that has a large portion of commercial real estate in their portfolio is in for a world of hurt. And unfortunately, it's going to be the little guys that take huge losses. Federal Reserve data from September 2023, listen to this, showed that commercial real estate comprised 44% of portfolios at small banks versus only 14% of the country's 25 big banks. You see what's about to happen? A lot of these small banks are going to be gobbled up. So what then? Sadly, it's only a matter of time. We're going to see Bank of America, Wells Fargo, Chase, all of them grabbing these smaller banks, cornering a larger monopoly in the banking industry. This is exactly what the Federal Reserve wants. They want a few big banks to control everything. It's clear that these collapses tend to impact smaller and mid-sized banks, especially those that are not well diversified. They make their money on these commercial real estate loans.
If you look at the balance sheet of both the regional and community banks, historically, their lending activities have comprised with a larger percentage of commercial real estate. And so just by the nature of the balance sheet having more dedication to commercial real estate, they're going to feel the impact.
What's worse is that these smaller banks are usually the ones that we talk about as being competitive with their pricing, and they are able to develop great relationship-based products with their clients because they know the neighborhoods, they can walk in face-to-face, much better than the larger big banks. So when they go under, of course, the big name banks are going to take their business, where they will continue to charge the highest rates on banking products like credit cards, personal loans. And in a country where our credit card debt is out of control to the tune of 1.1 trillion, this is troubling for Americans. Look at this. If 2023 was the worst year for banks since 2008, it's scary to think about what could be in store for 2024 and 2025 when all is said and done over the next 2 years. We'll get back to the video in a second, but look, your money is not safe. You can see all the time that stocks can crash, bonds lose value. Anything that you can't physically put your hands on increases your risk right now. Hey everyone, I'm Clayton Morris, longtime real estate investor and founder of Morris Invest. And my favorite tangible asset is real estate. It consistently outperforms other asset classes. And I believe it's the number one way to build and protect your wealth. Now, while there are several ways that you can invest in real estate, most of which I've tried myself, the build to rent model offers the most benefits. More specifically, single family buy and hold rentals. Here's why. Much lower risk than trying to flip a house. You have more control and higher returns than REITs. If you're investing in the stock market, it's way less work than wholesaling properties if you're into wholesaling. Many fewer repairs and headaches than trying to rehab a property. My company, Morris Invest, along with the help from our partner at Sedera Wealth, helps you invest in build-to-rent properties as easily as investing in stocks. That's because we buy and build in bulk, and then we pass on our savings to you. And when you purchase a property through us, you get discounted pricing on properties at or below market value. Seller incentives like mortgage buy-down rates and credits right now usually lowers your rate by about 1%. And we know with higher interest rates right now, you definitely want that, right? And you get free ongoing customer service for the life of your investment. Get personal phone numbers and email addresses of our team. And build-to-rent properties are in prime growth markets. We're talking 18% internal rate of return. 18%. Amazing tax benefits. And you get a free cost segregation report, helping find strategies that increase tax write-offs. You get principal reduction as your tenant pays down your mortgage. And you get steadily growing appreciation and equity gains. Plus, positive cash flow. We won't sell you a property if the math doesn't add up. If you want to know more, just click the link in the description box and it'll take you to our website where you can book a free call with our team. There's zero pressure, no obligation. Look, I understand we won't be a good fit for everybody, and that's totally okay. Some of you might want to be DIY, you want to do it yourself. That's great. Either way, you're going to walk away from our phone call with some valuable new insights and an idea of what questions you might want to ask and some actionable steps that you can take to move forward in your financial journey. You can always find an excuse to not invest, but the sooner that you start a smart investment like build-to-rent real estate in a strong market, the sooner you'll be enjoying pure cash flow. So click the link below and I hope to see you on our schedule. Look, as I've been saying here on the show, there's never been a more important time to get your financial house in order. Now is the time to pay down consumer debt, diversify your money, make sure you own tangible assets. I'm talking real estate, gold, silver, precious metals. Make sure you're invested in tangible items, folks, not debt right now. For more videos on insulating yourself from what's happening in the broader economy, just click right here and we'll see you in this next video.